right. Good morning, everyone. I hope you all are doing well. I'm going to give everybody another couple minutes here before we get started in earnest, but we've got a tremendous amount to cover for this quarterly market outlook. We always do. And this quarter is not only not an exception, but my goodness, I'm looking through, and the amount of slides that we've accumulated for this quarter, they number 84. 84 total slides. And we, it seems like quarter after quarter after quarter are accumulating just vast amounts of data. And we are parsing it down to come up with what we think is the final and best list for what we think is the most accurate and relative portrayal about the way the market and the economy are working and looking, and how we can help create a reliable forecast to help guide your portfolios. And that's really what we spend the bulk of our time doing. Is that, as you know, and those that know me have known me for years, every morning it's about research. Where are we? What's happening? Where are we going? Has the data changed? So let's start to talk about some of the data and create, again, a working context with where the market is now, where we think the market's going, and the most relevant and salient data sets to help us share the prognostication of how we see all this coming together. Some of the things are going to be a reinforcement of the trends that we've talked about quarter after quarter after quarter, with a lot of new data to go with it. So big picture, I wanted to point out there's a few major things at work. The first is we've got this 40-year sequential decline in bond yields. We've talked about this before, and how interest rates were in the high double digits in the early 1980s, and decade after decade after decade after decade, 4 decades deep, it has been a sequential long move downwards. And the reason why that's important to note is that as bond yields go down, bond prices go up. So it's been a nice, bonds are typically a nice a hedge against the volatility of the stock market. Bonds tend to be a little bit more stable. And when you've got bond yields going down and bond prices going up, and it's providing stability, it's been a wonderful, wonderful place to be for 4 decades, because you could get, good income and stable returns. But when you look at it like the kind of the classic 60% stock, 40% bond portfolio, the average return has been 17.8% over the past 3 years. That's exceptionally high. This year is we're seeing a material difference. There's something called, mean reversion, where when you have these pockets of exceptionally high return, there's always, the market's got a way of bringing things back down towards reality. So it's interesting to see, and there's a lot, again, we'll cover more there. Second point I want to bring up is that the GDP now projections are, the Atlanta Fed essentially puts it together, is showing a 1.2% decline in second quarter US GDP. That's concerning, especially given the fact that the first quarter we had a negative GDP print as well. We'll have to wait and see exactly where things come together, but part of this context, when we're trying to figure out what the market and economy are doing, we're looking at an economy that appears to be shrinking on a lot of levels. We'll talk about the good and the bad, and there are a lot of different good components that make up this equation. And then we'll talk about conclusions about what we're doing and how we're putting all this together in the portfolios. We see the consumers, they're slowing. We're seeing consumer spending increasing at a rate of 2.1%, which is a meaningful decline as you're looking at kind of that rate of improvement. We're seeing credit card spending surging. Part of that surge, in the surge, by the way, it's up at almost 20%, which is about as much growth in credit card spending as you'll ever see, as evidenced. Amex had good earnings this morning. Part of that is with inflation, higher prices, you're going to have more spending anyway. That's a component of it. But the fact that you're seeing a lot of credit card spending, and we're going to talk about the consumer's ability to sustain, it is providing an element of caution. We're saying, geez, how stretched is the consumer? And when we're seeing kind of consumer spending shrinking, we're seeing the amount that's going up on credit cards. It's giving us concern, especially when you fold it in with real wage growth. Wage growth is good. as long as there's not runaway wage growth where it's going to hurt corporate profits. But you certainly want to see wages climbing, and you want to see wages climbing on a real basis. And when I use the word real, I mean including and after inflation. So on an inflation adjusted basis, wages have grown, but after inflation, no, because inflation's so high, even though we got a little bit of wage growth, real wage growth was negative almost 4% this past quarter. So we're seeing, again, more pressure on the consumers and more credit card spending as a result. We'll talk about savings rates and all those things. And then we're folding in what the Fed is doing, because if you look over the past 13 years since the financial crisis, is that we have long since relied on the Fed to make sure that the market was going to continue to be smooth. Smooth performance, smooth economic performance. They had several mandates. They were mandated to make sure the economic growth was smooth and consistent, the job market was strong, and, oh, by the way, make sure inflation stays in a reasonable range. We all know that the Fed, in their effort to keep inflation in a reasonable range, has gone off the rails. The job market's been good, and economic growth is starting to show signs of real contraction. So it's a challenge, because understanding what the Fed's going to do, especially given 13 years of support from the Fed, and understanding what they're going to do moving forward, is key and critical to understanding how much upside potential the stock market could and should have. I'm going to get into more of that. Patience is going to be the key here. What we don't want to do is that we've taken a conservative stance this year, and we don't want to be jumping into the market too soon, if in the event the market's not prepared and ready to rise. So we do see some good signs where kind of that high yield part of the market, yields have risen a bunch, which is a good sign. Again, we're looking for classic buy signals. There's some momentum there. If you look at things like, the 2-year treasury a year ago was paying 0.1%, and now it's close to 3%. So there are some bright spots where things are showing some signs of improvement. We're going to talk more about what those things are. Got a lot to get to. I'm going to skip around and get through all the data. And as always, if you want our chart deck, send me or anybody in the office an email. We'll get it out to you right away. If you have thoughts or questions, Brett is tuned in, and he is going to send me text messages with questions as they come up. I'll try to get to all of them. And if I don't, we'll certainly email you with what we think is the best answer to your question. So let's get into this capital market outlook, shall we? And this is the first one as InterOcean officially. Isn't this fun? It's great. It's great fun, very exciting. But without further ado, let's get to Chairman Powell dressed up as a with the hawk outfit. So as we look at this cartoon of the quarter, essentially what it shows is that the Chairman Powell is changing his philosophy from that dovish philosophy to the hawkish philosophy. A dove philosophy means that the Fed is very worried about protecting economic growth. And so that's the term that Wall Street uses, dovishness, to say the Fed's going to be focusing their policies on making sure that they're doing everything they can to support economic growth, the consumers' balance sheet, make sure the consumers are working, all of that stuff. Well, quick change. He's zipping up his hawk outfit, and he is, and the Fed is vastly more worried about inflation, as they should be at this point. And if you look at the first 6 months of the year, really hard to identify a part of the market or economy that was growing. You had things, small cap international down 23, or small cap here in the US down 25, and emerging markets down 25. That classic 60-40 stock to bond portfolio losing 13.2% of its value in the first 6 months of the year. It was because you've got the taxable bonds down 10.3%. I'll show you in a later graph just how unusual it is that both stocks and bonds are down that much to start a year, how rare it is. It's certainly in modern history, it hasn't happened quite like that. Question is that where will we end up at the end of the year, and how are we going to get there? What are the most key and critical data sets that we need to look at to help uncover that? Obviously, the couple of shining spots were commodity futures You had a huge rise in oil being the number one. And what's nice is that since that quarter end in June, you've seen oil and gas prices come down pretty significantly. We'll talk more about that. You also had good positive performance in midstream energy and gold. And that's it. That was it for the first 6 months of the year. I'm happy to say we had nice positions in both gold and midstream energy. We worked to try to have some exposure to commodities, but goodness, anywhere else was a real difficult area to invest in. More charts than time. So inflation. So with regards to inflation, there's a couple of different concepts I want to make sure that we are all well aware of. One, and the first is CPI. This is again the core inflation measure that many certainly in the media will use. The people say that the Fed uses the PCE rather than the CPI, but the CPI is a good consistent way for us to get a look at what the trend is with inflation. And the other is PPI, which is the producer price index. This is what companies have to deal with as prices are rising. This is what consumers have to deal with when prices are rising here on the left. So you can see that prices in the CPI, again, appear to be rolling over, albeit from a really high rate. There's more anecdotal data, certainly in the month of July, that we're seeing that inflation is starting to cool down. It's important to note that that's happening simply because of this, is that the Fed is so tuned into what inflation is doing that if inflation starts to roll over, you may end up getting some relative excitement from the stock market that the Fed is going to end up doing less to be restrictive and less accommodative. Because what the Fed is trying to do right now is they're trying to raise interest rates and shrink their balance sheet to slow economic activity down. So there will be a point where, if and when inflation starts to roll over, the market may get excited to say, geez, this may be less restrictive and more accommodative than we first thought. Could be a significant rally point. We are watching for that very carefully. We don't think that we're in danger of that happening in the immediate future because we do think the Fed is still really far behind the 8 ball. And I'll show you some of the data in the next coming slides about what that looks like. In the producer price indexes, this is again, as producer prices are going up, we're worried about companies' ability to continue to make profit. The big components here, of course, are wage gains, where employers are having to pay their employees more. They're having to increase the price of what they're trying to sell because their input prices are going up. This is pretty significant. If you look at what inflation is doing and rolling over, if we have 0% inflation growth between now and the end of the year, if we print a 0 rate of inflation growth 5 months in a row, our inflation rate will go from about 9.1% down to 5%. In 5% inflation still riding hot. We're going to have to talk about whether or not we think that's likely. We do think there's some particularly large challenges with us getting that 0 print, but we are hopeful because we are seeing some signs that inflation has rolled over. We've seen, again, the commodities start to roll over and their year-over-year growth changes, year-over-year growth patterns starting to change meaningfully. And yet at the same time, we've seen home prices increase a lot on a year-over-year basis. Here in Arizona, we're north of 20% year-over-year price increases. We about lead the nation there, as we typically tend to do here in the desert Southwest. Not all markets are created equal, but nationally, home prices have increased 20%. What's interesting to know with the way inflation numbers are calculated is that home prices are gradually added into the CPI numbers. So they're not, this whole year-over-year increase of 20+% nationally for home price movement has not been fully factored into CPI yet. So for as much improvement as we're getting on the commodity side, as commodities are coming down, you got these housing prices that data is going to continue to feed into the CPI number. So that whole hope that we're going to get this 0 print for 5 months in a row, or maybe better, to start to bring inflation down in a meaningful way, might be tough to find. If you look at inflation, it's not just here in the United States. I've shown you this chart. This is updated data. We're seeing it across the globe. Again, this indicated chart shows that this may be rolling over. So if inflation is rolling over or worldwide, that's particularly helpful. We're watching the 2-year Treasury because, again, what we're trying to figure out is where's the Fed going to stop? I'll put it this way, is that the 2-year Treasury, which is currently right around 3% today, it was as high as 3.25. As the 2-year Treasury goes, so goes the Fed increasing interest rates, kind of that Fed funds rate. Here in blue, you can see the 2-year Treasury goes up, and then the Fed funds follows it. It's pretty much in lockstep. Look at the gap difference between where the 2-year Treasury is and where we have Fed funds. There's a lot of discussion about, well, how quickly can they just get us to 3% and then we'll be there? We saw a 75 basis point increase last Fed cycle. Will we see another one? That's kind of the consensus estimate that we'll see a second one of that magnitude again here soon. Then the month of August is a delay. There's no new changes in August, but then September the Fed will get right back to it, and we'll see where they're at. If will this reach that 3% threshold? We don't yet know. The market believes, if you look at all these different colors which relate to subsequent investment Fed meetings upcoming, that we're supposed to get Fed interest rate increases up to 3.5%. We think this is an overshoot. Not only do we think this is an overshoot, but the market's projecting from where we are, Fed increase here. Again, you're looking at about 75, followed by another 75. And then you're getting into these more 25s. And then by the end of next year, the projection is that they're going to start cutting rates again. This all of this together means that the market's projecting the Fed's going to need to increase interest rates because they're so far behind the 8 ball, and then they're going to be forced to reverse course almost immediately thereafter because the economic environment is going to be one of pretty significant contraction, i.e. a recession in 2023 is what is projected. They think we can kind of close out this year, but then things start to look a little bit worse, even by the first quarter of next year. Good news, market projections aren't always right. So we try to take the contrarian view, not necessarily just to be opposite of what everyone else thinks, but we do want to be both early and right. So we think that this is probably too high of an overshoot on the interest rate increase side. We do agree, though, that the Fed cuts will follow shortly thereafter. Part of the material change that we've seen is we've seen home prices skyrocket, and we're likely going to see those home prices start to taper off in terms of the rate of increase at a minimum. Look at the mortgage rate increase. We were in the 2s. We shot up to 3% rather quickly, but then we went from 3 to touching over 6% on a 30-year mortgage like that. And I snapped my fingers simply because it was the quickest increase to the 30-year mortgage in a percentage basis on record. We don't know what the impact is going to be exactly on the home market, but I can assure you the fact that we know it's not very supportive of a continued increase to home prices. In fact, it should mean that home prices start to roll over here at some point soon, which again, the Case-Shiller top 20 home markets, you're seeing a topping effect there. This doesn't surprise me if we stay in this range of this 5.5% for the 30-year fixed mortgage. I would anticipate it being an environment where home prices have topped and start to find their way down. This chart I've shown you before. This is just an update. This is the cyclical nature of home prices. So I speak to you from a period of looking at the data. This does seem to indicate exactly what's going to happen. When we are looking at the stress that the increased 30-year mortgage is putting on consumers and high home prices are putting on consumers, we've been hopeful because this yellow line was looking great, which shows wage growth. So consumers on balance, wage earners on balance were consistently year over year, quarter after quarter, month after month for a large pocket of time, making way more than inflation, which is wonderful for spending, which is wonderful for our economy and our economic growth. So anytime you see this gold line, which is the wage increases, over the inflation line, this is a great thing for consumers. It's a great thing for economic expansion. It doesn't always mean, by the way, that the stock market gives you great performance when you get both of those things. There are so many different economic elements that go into creating the perfect recipe for what the stock market's going to do. This is an element. But if you look, inflation was really low, and wages were certainly a heck of a lot better than that in 2015 to 2016, and the market was flat to down that year. So it's not great. You want the perfect Goldilocks scenario is a little bit of inflation, wage growth. These are kind of the great numbers. This is where you start to get it being problematic, where inflation is much higher than wages. I mentioned real inflation, I'm sorry, real wage growth was negative 3.9%. Here you go. Here's your data. This is where consumers are starting to feel the pinch. And as a result, I have some data, if we can get to it, that shows just how negative the consumer is right now, with as measured by consumer confidence, the Michigan survey, University of Michigan survey, which has it's historically followed with a pretty negative impact to stocks. So you again looking at real personal income. This is excluding the transfer payments from the government. We're kind of back on trend here. Here's your COVID environment. We're back on trend with wage growth. But if you're looking at disposable income with high gas prices, higher mortgage rates, we're seeing those things take a real bite out of disposable, spendable income. This is tough. Oh, and by the way, not the least of which is it not just mortgage rates, and it's not just gasoline prices, but it's also rent. Rent prices and rent affordability has been so disjointed that the figures are the worst that they've been in decades in terms of the rate of change with how much rents have gone up relative to income. This is another way to show it. It's showing up in disposable income. So we're watching that to make sure that the state of the consumer can handle it. Again, personal savings rate is another element to how healthy the consumer is. It's hard to say exactly what a good savings rate would be for the US consumer. We know that during COVID, and we had massive transfer payments coming from the government in the form of COVID relief to consumers. We know that a lot of this was saved, mathematically justified here. We know that as COVID has subsided and the economy has opened back up, that the savings rate has all but dissipated, gone away, and we're kind of at this historical norm of this 5% or so historical consumer savings rate. Yeah, we've run, for a long time where the consumers were saving less than 5%. It doesn't necessarily mean that if you're running a consumer savings rate of under 5%, that's necessarily bad for the stock market. It could be good, but we're just worried about how long the consumers can sustain that kind of spending. I'll get to both of these charts. This is that the credit card information that I was talking about at the top of the hour. You look at the right here, the result, I say revolving credit, think of credit card debt. The rate of increase was consistent. There were small pockets of change. COVID hit, and we are right back on trend. If you look at the numbers in April alone, the rate of change in credit card spending in that month alone was the highest ever recorded on record. Now, this is to say that we're back on trend from where we were, but this is showing the consumers are going to start showing a little bit of a sign of strain. We also know the consumer spending numbers are coming in a little bit. So this is all part of it folding together. But on balance, partially because interest rates have been so low, the consumer has been very able to make their debt payments. Part of that is a strong job market. Part of that are those wage gains. Part of that is low interest rates. But on balance, this shows that the consumer is on balance pretty healthy. We are a little bit concerned with the credit card. So we're showing these different elements. And as I put them all together and as we extrapolate, what we are showing is a consumer that's at a crossroads. And this is exactly the point about why we have been and continue to be more defensive. Given the fact that the consumer can handle what's been happening right now, that's great, but we don't see a lot of room for significant expansion for consumer spending, which gives us a little bit of cause to pause at the moment. And what we see more so than, well, does the consumer have ability to expand what they're spending? It almost looks as if it could go the other way, where the consumer might spend meaningfully less, where there's just less room to stretch on a credit card, wages are coming back in. And we're seeing this in two different sectors of the US economy, both manufacturing and services. I'll toggle back and forth here. Manufacturing is a smaller part of our economy. Think of it being about, somewhere between 30 to 40% of our economy. Services, somewhere between 60 and 70% of our economy. Obviously, they make up the balance, but we're seeing economic activity for services decline. We're seeing a decline in manufacturing. This is, by the way, a rate of change. This is the way that you're doing the trend analysis. So the trend analysis indicates that we're seeing some slowing in manufacturing. We're seeing some slowing in services. Both are still growing, but growing less quickly. This is, we're looking at, okay, is this going to be the trend where we fall below the black line? And if you fall below the black line for either manufacturing or services, that shows contraction. This is where you get the recession. This is where you get the recession. But it doesn't necessarily mean every time you see these things come down, it doesn't come with a recession. So there's no guarantee that this thing falls below the black line on either services or manufacturing, and it comes with a recession. But I am seeing this yellow, new orders manufacturing in contraction, new orders in services coming down. Not quite in contraction mode. But if the new orders is that future forecast, that's showing us a little bit of a canary in the coal mine. That is kind of one of the more negative economic data points that I can point to say, geez, why are you guys continuing to be defensive? We're seeing this trend, and we want to make sure that it's in a meaningful reversion before we get more constructive on the market, before we start to take more meaningful risks with client assets and portfolios. I mentioned the Atlanta Fed GDP Now estimate. That first quarter was negative 1.6. The latest read on the GDP Now is negative 1.2% for the first quarter. I'm sorry, for the second quarter of GDP growth, which would be a challenge. How's the market going to digest it? And there are other elements and ways to look at the economic strength, and we're going to look at two different areas here. One is travel, and in travel has rebounded virtually, and if you've traveled lately, virtually to levels where we were pre-pandemic. Doesn't mean travel's gotten any easier, but in terms of the amount of people flowing through TSA, we're about where we were. But it's not about where it was, the amount of people that have come back to work. And if you look, here are your major markets across the country: New York, DC, Austin, Dallas. Here's your list. And then what are the percentage of people that have come back to work and gone back into the office? Some of the places where we've gone back to work the most, almost 60%, like Austin, maybe Houston, maybe Dallas, right? These are your three best areas. For those of you that know Texas, that makes some sense. And, markets like San Francisco or New York being one of the worst performers in terms of coming back to work. But the major metropolitan areas, you're seeing the rate of return to work that is it's lackluster and not impressive. Here's the scoop. We're going to look to see, once kids go back to school en masse in September, if we don't see a meaningful uptick in the amount of people that are returning to the office, this may mean that office-based real estate, which we're not very positive on anyway, this may mean office-based real estate could have a huge issue going forward. And eventually, because leases will start to roll over, and you may see a bunch of vacancies that can't get filled. We'll have to wait and see, because businesses may end up needing a heck of a lot less office space. I mentioned that we saw oil prices and even gas prices. Both of those have rolled over. Again, I don't want to dismiss the fact that they're still on a significant uptrend. This rolling over may be a short-term move down and kind of the same kind of reset that we got here in the beginning of 2022. We don't yet know. We're watching it. It is interesting to note that if you lay out the price of energy in Biden's approval rating with consumer confidence, all of those things tend to go hand in hand. Although we've seen the price at the pump improve and we haven't seen Biden's numbers improve, it's interesting to see that these trends, historically speaking, are usually locked up pretty tight. And speaking of being locked up pretty tight, is the upcoming election in November. Now, we're going to have more information in October, of course, because for our next market outlook, we'll be a couple of weeks away from midterm elections. We need to keep our eyes focused on the Senate race. If we were talking about the Senate race 3 months ago, it was a Republican landslide. If you look at the latest data, it's interesting because there are these 7 races that are deemed to be toss-up, and we're basing that on the latest polling data, which, right or wrong, if you look at the average of all the polling data, hopefully you get something that's about par. And without those elections yet being done, these 7 states across the country are going to dictate whether or not the Senate goes Republican, Democrat, or again, right now where we are is like somewhere in between. Smart money is on Republicans winning the Senate control in the midterm elections. We'll have to see how that comes out. What this means for the portfolios is we would be more constructive if there was a Republican House and Senate. And we say that not for any political reasons, but we know that on a historical basis, when you have either a Democrat in office holding the presidential office with a Republican House and Republican Congress, if that kind of environment tends to be a stock market that performs better. So that we're all for that. We're all for economic growth, and we are usually not keen on the government doing a lot of big sweeping changes, either side. And it's going to be really hard to get big things done if the Senate is being controlled by Republicans with Biden in the White House. So we'll have to wait and see how that comes together. It's interesting how tight that is, especially given where we were just a few months ago. We'll watch and see how that comes together. We're also going to watch to see how European natural gas prices flow through. Europe is in a difficult spot, and so are we with our international investing. We spend a lot of time. We have talked with our managers. We have talked with our CIO teams. We have met internally a lot about whether or not Europe's challenges with their energy crisis, whether or not we are going to make a meaningful change to our investment portfolio. Are we going to reduce the amount we have internationally, given what Europe is likely facing the remainder of this year and into 2023 with their energy consumption needs? At the moment, we are maintaining our international positions, but our finger is on the trigger, and we are acutely aware of the challenges that are facing Europe. And we are not and will not hesitate to make a meaningful change in the portfolio structure if we feel like the international markets are going to struggle in any meaningful way. So, they would principally struggle for 2 reasons. One, they're struggling with inflation, and their Federal Reserve, their European Central Bank, has done a lot less to catch up to where our central bank is. So they're way behind where we are increasing interest rates. They just did one this week, but they have a lot more work to do, which is a lot more pain to come. And they have an energy problem that from an infrastructure perspective, they can't fix. All right, so we'll talk more about Europe, I'm sure, in the coming months and quarters to come. Year to date, not a lot of great sectors to invest in. These are all negative. the one shining star was energy. Again, thankfully, we had an emphasis on energy this year, which is great. For those of you that have the position, the MLPX position, that was one that we featured across many of our client portfolios for this reason. But otherwise, it has been a veritable graveyard of opportunity. If you look at what has happened just in the month of July, what a difference a few weeks makes. Consumer discretionaries and in technology, the NASDAQ has rebounded significantly just to start the month of July. I looked, the market was up this morning, it's down today, but point is that quarter to date, there's been a nice rebound in most areas of the market, but again, on a year to date basis, it's been a difficult situation in terms of where we're going to find viable investment opportunities to actually grow our client capital. So should we have money in stocks at all? And what do we expect from stocks in their earnings? Super critical, because if we can see an environment where corporate earnings are going to continue to grow, that usually translates into good stock performance. Well, to start the year, the projection was for a little bit more than 10% earnings growth for publicly traded companies. Now we're right around 9.9% projected earnings growth. So we're about the same. So company earnings growth continues to forecast well. So for that reason, even though we have been protective and we have been, even though we have less stock exposure than we normally would, we're not completely out of stocks for that reason. We've also seen a pretty nice improvement in the multiples, meaning that stock prices have gone down, earnings have stayed where they have projected that they will be, dividends have improved. All of that said, if this trend continues, and if corporations continue to be able to deliver good earnings performance quarter after quarter, and so far for the second quarter, what we've seen is good earnings growth. We have seen some companies like JP Morgan that have come out with throwing in the kitchen sink in terms of all their different negative earnings announcements, in different negative, all the different things that they can throw out there to say, we're worried about this, worried about the consumer, worried about inflation, worried about. We haven't seen a lot of companies do that same thing. It certainly hurt the JP Morgan stock. If we saw a lot of companies doing the same thing where they're sharing with you all their fears and anxieties about what could go wrong, that's the kind of environment that creates a real negative atmosphere for stocks and for earnings. So we're watching corporate earnings, which look pretty good right now. We're looking at earnings growth, which also looks pretty good. And we've got our finger on the trigger there, whether or not we need to get more defensive. If you look here in gold, this shows what the average earnings multiple has been on a historical basis. Sometimes when the stock market can go way above the norm, like the dot-com bubble, we went way above the norm where we were when we recovered from COVID. That was also because earnings were way down because we had the economic shutdown and we had price improvement. So earnings took a little while for earnings to catch up. They did catch up. So now you've had earnings which have been strong, stock prices which are down. So you're seeing this come to a more reasonable range. If you're looking for a formula to say, when can I buy stocks they're at their cheapest? It's this kind of green line down here, your mid 90s, certainly the perfect time would have been down here at the worst part of the financial crisis, or when the US lost its AAA rating here. We're going to watch, because if we end up getting to this level, anywhere down in this range, I can assure you that's the kind of contrarian view that we have. We say on a historical basis, we feel that valuations look really favorable for the stock market. That will probably be at a time where you'll say, I don't want to go anywhere near stocks. That's usually when you want to dive in. This is a graphical way of displaying exactly the way that our mind works in terms of whether or not we think the market's over or undervalued. We're kind of in this sub fair value mode right now. We would love to and be more excited about stocks down in this range. And this is where, in certain environments, we're looking to get more conservative. This is just another way of illustrating the same thing in terms of earnings on a go forward basis in terms of where we are from a valuation standpoint. Yeah, we're seeing, pretty nice improvement from growth to value. Okay, when we're looking at corporate earnings, not all corporate earnings are created equal. Different sectors of the market will perform better. Earnings on bottom and sales on top. Different parts of the US economy here. And if you're looking at estimates for 2022, anything in red is negative, and you're seeing, again, negative number projection for sales and financials and earnings for financials. But for the most part, you're seeing a lot of blue in terms of you're seeing projected earnings and sales growth quarter after quarter after quarter. We'll have to see where and how that comes in. So yeah, we've been very light on financials, thankfully. We're light on utilities. We have almost no utilities. In real estate, we're light on as well. So we're seeing parts of the market that may have some problems. Industrials are looking better. Energy continues to look good. This is more of a rebound in earnings than anything else, but you'll see us use these data points to try to find areas to identify where there's value and opportunity going forward. We also look at the sentiment index, and there's at one point the bearish sentiment index in terms of how concerned people are with the market and the economy was all the way, the concern like hit a maximum level a few weeks ago. That has since rebounded, but you can see, graphically speaking, that we're still have pretty negative sentiment. People are very concerned about the stock market. That hasn't rolled over meaningfully. These kind of trends, unless this changes, the trend is still negative. We'll have to see a real change in the stock market sentiment in order for that to reverse itself. But for now, we're moderately constructive based on that information. Here's something that I want to point out that's both key and critical to answering a question about why we don't pull all the money out of the market, or when will you get more constructive on the market. There's another data point that we look at, and when inflation is high, north of 6%, and we're certainly there now, and rising, and inflation's, if it's higher than 6 and rising, the stock market historically does not perform well. However, when inflation is high, over 6, and falling, the market tends to perform extremely well. This is, so if we start to see inflation rolling over, and we're seeing it now, I expect to see, while this trend is in place, some pretty reasonable returns, as evidenced for what we've seen in the month of July. This, so is this a complete buy signal? No, because we don't know exactly the depth with which and the rate with which that inflation is going to be falling. Right now, the market's projecting it will fall. But as I mentioned before, don't forget, home prices are going to have this kind of magnet effect that's not going to allow the inflation numbers to fully move as low as you think that they would, especially given the fact that gas prices have improved and oil prices have improved, and we're seeing home prices start to level off, if not slip a little bit. It's not a buy signal, but it is another point in the camp of, this is part of the reason why the market's been rising this month, and we continue to be watching it. And if there's some kind of reversion where if inflation is over 6 and stable, you can see that the market environment changes instantly. We're watching it, we're aware of it, now you're aware of it and how that works. If you look again, I said I'd have consumer confidence information. Consumer confidence hasn't been this low ever. It's shocking because you think that the depth of the shut-ins and the COVID lockdown, that would be it, or the financial crisis. And that is not the case. This just shows you why the Fed's mandate of keeping inflation in check is so critical. High inflation and high prices whether it be at the pump or at the grocery store or at the movie theater or anywhere else that you may be going, has a real negative impact on a consumer's ability to feel confident about their own finances. And it's no surprise that as consumer confidence meaningfully rolled over, the market eventually followed. And there's usually a pretty good trend as consumer confidence falls, you get, it's a signal in many cases that the market's going to fall thereafter. Doesn't always fall in lockstep. They don't move in perfect tandem with one another. But this level of consumer confidence is alarming. We'll have to wait to see whether or not this is going to be a rebound. Now, I will tell you that at the same time, the contrarian in me knows that if I could have bought stocks at the bottom of every one of these consumer confidence pits over a long period of time, you'd be really well off. I'm just not seeing that buy stocks with both hands signal quite yet. Okay, equity risk premium. Look, what can I tell you is that we're seeing things come in and rein in a little bit with stock prices. We have to see more economic data come in order for us to have a better understanding what the Fed's going to do, which will translate into a greater understanding of how we're going to evolve client portfolios. And we are going to exercise more patience than normal. And we're going to let the data come in before we commit early, find out that we are indeed in a recession that turns out to be worse. The Fed has to do much more than we thought that they were going to do, and ends up squeezing corporations because they have to increase rates more, shrink their balance sheet more, and it's so restrictive, their policy, it ends up creating a real difficult economic environment. I, for one, am not going to act early. I'm going to be patient and be consistent with what we do there. So as you look through a couple of other interesting economic data points, one is you look at the amount of companies that have exited or had a successful exit or sale. It's what a year we had last year. We have almost effectively none this year. If you're looking at the amount of capital raised, it's much the same. By the way, this is a good sign for, we're looking at venture capital funds now because we're starting to see a real disconnect there. This is where we, again, use our contrarian view on the market. We are looking at VC funds. These environments where you're having epic amounts of money raised and exits when it's at hysteria levels, that's not what we're looking for. We're looking for our ability to buy low, and we're seeing potentially some opportunities there. So I would look to see us come out with some, hopefully, if we can find them, pretty interesting venture capital related investments, hopefully coming soon to a investment portfolio near you. Here in this salmon color, that's the best way I know to describe it, is the bond market of this year. These are the bond markets that go back decades. Now, rarely do we have a negative bond market. Last year was one. This year, from historical context, can you see just how much worse this bond market has been year to date? I look at this as the vast majority, if not all, of the negative news has been priced in with relation to interest rates. So there are certain parts of the bond market that we are more actively contributing client capital to. We are increasing, in many cases, the amount of client exposure to municipal bonds for that reason. We would not use this as a sign to say, hey, go buy a whole bunch of junk bonds, because you don't want to owe junk bonds if in the event the economy does go indeed into some kind of a recession, depending upon how deep it is and what it looks like. I couldn't tell you, I don't know, but we are using this as a signal to say this probably a good time to start buying a little bit more in the municipal bond market. So you may have seen some of that in your portfolio. If you look at what else the bond market is telling you, this is an inverted yield curve, and now it's more firmly inverted. If you look back historically, as I've told you, quarter after quarter after quarter for years, inverted yield curves precede recessions almost every time. Wouldn't surprise me if we get one. The depth and magnitude of it, we don't know. Look, there are firms that are calling for this to be the most mild recession on record, and they point to how strong the job market is as a way to say, there's proof that we're going to have a very light recession, because you can't have a huge recession when you have almost everybody fully employed and wages being at a pretty high level. That's a very optimistic way to view the world. I hope that's what happens. You can call that like a soft landing, if you will, but there's something in me that feels that we need to be cautious, because the odds that the Fed can architect a soft landing, especially with all the different elements that are outside their control, seems curious to me. Where you can start to see us get more excited about high yield bonds, I just mentioned that we're not at the moment, would be when they're in this green or certainly dark green range, where you look at these as, great buying opportunities. Interestingly enough, we almost hit that level recently. We came back off of it, but we're looking, we may add high yield bonds this quarter, maybe next quarter, but we are looking for them to looking at the data holistically to provide us a real buy signal. So we haven't quite seen that yet, but we're watching it. Okay. Again, have I said 10 times yet that there's more data than time? We've got tons of data, not enough time. US yields, our treasury yields versus the rest of the world. It's about the highest we are for anywhere in the developed world economies. This is part of the reason why we feel that our rates can only go so high, because we're so much higher relative to the rest of the world, especially given our quality. You would think that we would be, towards the bottom in terms of yield, but the fact that we pay more than Portugal. Would you rather have a 2-year Portuguese bond at 85 basis points or a US bond at 315? No argument that our economy is a heck of a lot more robust, diversified, and strong than Portugal. So why would you ever buy this when you could have that? Yeah, there's a natural anchor that keeps our rates low, is what we feel. We're seeing pretty significant dislocations in the yen. Our 40-year sequential decline, as I opened up this call with, is largely intact, but look at the 10-year treasury yield. We're bouncing off of this level. Will this end up being the real reversion where we see a new dynamic with the 10-year treasury? We're going to let the data show us first, because we know that there's so much total indebtedness that the country has that it's going to be a real struggle for the 10-year treasury to run away higher with the amount of total indebtedness that we have, because we still have to finance those debt payments as a government. In part of the reason why we've been able to expand our government's balance sheet and have so much debt is interest rates were getting lower and lower, made our borrowing costs less and less. But as interest rates rise, our borrowing costs grow as a country. And we are watching very closely this debt to GDP ratio. We saw massive, by the way, incoming tax receipts in the second quarter, which is part of the reason why the debt to GDP improved a little bit. Point is that we are watching it, and we, at the moment, don't believe that the 10-year treasury is going to create a new trend for that reason. Foreign holdings of US treasuries, I could spend a lot on all of that. Yeah, we know that the supply chain issues are easing, which is good. I read an article this morning that we went from nearly 100 shipping container ships at the LA port to now down to 20. They want it down to 0. They've picked up a lot. They've made some nice investments, and they have picked up new efficiencies. So you can start to forecast when the shipping backlog at the ports is effectively gone, but you've seen improvement there. We've again seen the price of oil rebound. You've seen rig counts come up on both natural gas and oil on a rather consistent basis, but nowhere near as fast as what you'd expect given the historical linkage to, as oil prices go up, so goes rigs. We've seen a real break there. There's still some uncertainty from these energy companies about what they should be doing, but we've seen improvement there that has helped. with supply that has helped with prices. Uh, Hopefully we'll continue to see rig count rising on both the natural gas and the oil side. I suspect that you will, especially with oil prices maintaining that level. Crack spreads, again, talking about coming down because this is related to gas prices. I mentioned, our exposure to the MLPX position here. This is the Alerian MLP, slightly different. We've seen great performance there. We've seen performance in energy, where tech stocks, S&P 500 tech has, the free cash flow yield has not improved. Free cash flow yield's been particularly good for MLPs lately. We're cautious on REITs. So as we look at different elements of the market in the Fed, we're looking at what is expected. We're going to put into historical context a couple things with these last few minutes. Here's your year-to-date performance for stocks and bonds. 2015 was a negative for both. 2018 was a negative for both. By no means did you have both portions of the market that negative. Certainly, so we haven't seen anything like this. You can go back to the mid 70s. We haven't seen anything like this from a performance standpoint. But that also shows that we've been in this, again, this 40-year sequential decline in interest rates, which has been a favorable bond market for the most part. But given the fact that we've seen stocks and bonds in tandem down so much, it wouldn't surprise me to see some level of improvement. And we've seen some meaningful improvement here. You've seen this chart. This is the same chart I've used in a couple of other quarters. And if you go back a few quarters, what you would see is the expectation for large cap stocks was closer to that 1.5% range. Because stocks have gone down as much as they have, the 10-year forward outlook for large cap stocks has improved to about 4.5%. This is a good thing. So we will be more constructive on stocks, particularly if the stock market does continue to fall. We are acutely aware of all the different economic data sets, not just here in the US, but internationally. We are evaluating those portfolios on a daily basis and working hard to figure out where we need to put your assets to put you in the right place for the right amount of protection and growth and of course, liquidity. So on balance, we remain constructive with what it is that we hold and the particular leanings that we have. We are worried about what the Fed may end up having to do in the face of inflation, which we do see rolling over and improving. How quickly will it improve? Will the Fed just need to put their foot all the way down on the gas and increase rates higher than we expect? If they end up doing that, then things end up breaking. There is going to be some sort of dislocation. That's the most negative way to view the market. The more positive way to view the market is we've already seen the market correct. We're at full employment. We've got nice wages. You add up those elements together, it looks like it's going to be a soft landing. And we're prepared for both because we're not prepared to say one way or the other, if this is exactly what's going to happen, we're all out of the market. We're just trying to position you correctly by leaning into parts of the market we feel will perform best, leaning away parts that we feel will be more challenged. And all in all, we are always here to answer any questions that you might have about your portfolio, the market, the economy. You can reach out to us at any time. I really and sincerely appreciate you spending time on the market outlook with us today. We look forward to talking to you next quarter. That's it for now. Take care and have a wonderful, wonderful summer. Bye-bye.